Good morning, everyone. Thank you for joining us for this second episode of the BWC Dialogues series. This series is a platform for our members to share opinions, ideas, and gain expert knowledge on real-time emerging issues or events. Because of these, we would love to hear from you about any topic ideas or whether you would like to volunteer to be one of our speakers. Please feel free to reach out to myself, to Zach, to Emily Slater, or to one of our directors and see how we can work together in bringing more ideas to life. We do hope that you appreciated the elegant humor in today's title, Fed Up. And on this note, let me introduce our speakers. We have Hayley Boesky, Executive Vice Chairman, Global Corporate and Investment Banking, Bank of America. Thank you, Hayley, for being with us. William Dudley, our Chair and former President of the New York Fed, and William Rhodes, Vice Chair of BWC and former CEO of Citibank. Before we dive into the conversation, I'm going to do a little bit of housekeeping. Please keep your devices on silent. This will be a dynamic conversation in two segments. We will have Bill Dudley opening the conversation and interacting with Hayley and Bill Rhodes. And after their interaction, we will open the floor to a Q&A session with you all following us online. So please, if you have any questions, post them to the Q&A tab, and we will give you the floor. I will be calling your name during the Q&A session and allow you to ask your question live. I am going to give the screen to Bill. Bill, please, let's get started on this dialogue.
Okay, thank you very much, Elena. I'm going to start by really focusing on the Federal Reserve report that was published a week ago on Friday, where they went through and analyzed what happened that led to the failure of Silicon Valley Bank, and talked about what needs to be done to avert these kind of failures in the future. So I'm going to talk about what the report said, what the immediate consequences are, and what was left unsaid, because there were a lot of things in the report that were issues that were not covered. So what did the report say? First of all, it said that Silicon Valley Bank, not surprisingly, that there was a failure of board and the management to manage the risk of the bank. No surprise there. Second finding was that the Fed supervisors did not fully appreciate the vulnerability of Silicon Valley Bank. And third, that they didn't take sufficient steps to ensure that Silicon Valley Bank fixed their problems in a timely way. So there basically was quite a bit of criticism of the Fed's own supervisory processes. And the last major conclusion of the report was that the board's tailoring response, and this is when the Fed uses discretion for banks between $100 billion and $250 billion to use a lighter touch, that was implemented after the 2018 legislation, that tailoring approach didn't work very well in terms of addressing the financial stability of the banking sector. The board's tailoring approach led to a reduction in standards. It led to increased complexity, and it promoted a less assertive supervisory report. There are also a couple other conclusions in the report about just the nature of the financial system. One, the report highlighted the speed of bank runs that's gone up dramatically. Two, that size is not necessarily a sole aspect of whether a bank is systemic. A bank might not be very large, but if there are a lot of banks that look like that bank and that bank fails, it can actually have systemic consequences. And the report concluded that capital matters. At the end of the day, if you have strong capital, people don't worry about your solvency. If people aren't worried about your solvency, then they're not going to run. So the immediate consequences of this report are that the speed and force of supervision is going to pick up. The cadence of supervision is going to pick up. So when supervisors find something wrong with a firm, they're going to push that firm much more rapidly to solve those problems. So that's going to be, important in terms of the amount of pressure on banks to fix things in a much more rapid way. The second thing I think they're going to do is they're going to revisit the tailoring approach. So I think we should expect tougher prudential standards for banks in the $100 billion to $250 billion asset class. Third, I think they're going to review the capital standards, especially the accounting in terms of how we treat securities that are held in the hold to maturity bucket. What happened in this case is that the book value of capital in case of a bank like First Republic was far higher than their actual market-based capital on a mark-to-market basis. And so the question is, do we have the right accounting for banks? And the last thing that they'll probably take a look at is how our bank CEOs compensated. This is one aspect of the Fed's report that was a little unusual because Barr actually went into this issue of compensation, which could have been left unsaid in this review process. So I think what's going to happen is tougher supervision on a day-to-day basis, less tail, no longer are we going to have this tailoring approach for banks between 100 and 250 billion. A review of the capital standards, especially accounting, and a little bit more focus on compensation. Now, given all that, there was a lot that was left unsaid in the report. Where the report, I think, was silent was on a number of different areas. Number one, there wasn't much discussion about the whole issue of asset liability management. In other words, what kind of interest rate risk banks are taking on their portfolio and how to deal with that, because that's obviously one important aspect of why Silicon Valley Bank got into difficulty. Number two, there's no discussion of deposit insurance reform. The FDIC recently has talked about raising the deposit insurance limit for businesses, checking accounts, so they can basically not have to move from one bank to another when they're worried about a bank getting into difficulty. There was no discussion about the lender of last resort function. Should collateral be pre-positioned at the Fed? One of the problems in Silicon Valley Bank is they literally ran out of cash on the Thursday that they failed because they couldn't get the collateral that they needed to the Fed. And then the last thing, probably the most important thing that's silent on all of this is what's the role of monetary policy in all of this? If you look back at what happened, the Fed basically kept interest rates very low for very long. They engaged in quantitative easing that dramatically increased the amount of deposits in the banking system. And then they reversed course by tightening monetary policy pretty aggressively. So the consequence of QE was banks had a lot of deposits that they needed to put to work. Some banks took those deposits and bought long-term assets. And then the Fed made those holding the long-term assets not very attractive by raising interest rates very, very rapidly. So I think the role of monetary policy in all of this is something that needs to be debated and discussed. In general, I'm pretty positive about the report because I think the Fed was very self-critical here. It recognized that it can do better on supervision. But I hope that the Fed doesn't just look at this as a supervisory problem. I think the problems go deeper and broader than that. So let me turn now to Hayley to get her assessment of what's happened in the banking system, the market reaction, and what you think might happen in terms of the regulatory side. Hayley?
Thank you very much, Bill. And thanks to Bretton Woods Committee for putting this together today. It's an honor for me to be here with Bill and Bill. I guess I just want to kick it off by saying that, stating the obvious, that investor sentiment is extremely fragile. Investors are, looking right now for the next shoe to drop. They want to know which bank is next in line to fail. Bank equities have continued to suffer as regional banks are failing. Although today there seems to be some relief in the market, at least when I last checked. We see that stemming from some short sale covering, given there are rumors circulating of a short sale ban. So that's giving some support to the equity markets today, but I deem that to be temporary. After the FDIC takeover of First Republic, concerns really only escalated to a new level. And that's reflected in the KBW Regional Banking Index, which is down 34% year to date and was down as of this morning 11% over the past week alone. So markets are functioning in certain areas, but there are serious strains. Equity markets remain closed to new IPOs. We did see some new debt issuance and investment grade. There was a $25 billion deal done on Monday, but they're far and few between. And then, the equity sell-off in some of the small and regional bank stocks have extended to the G-SIBs, where we're seeing fairly large declines in their stock prices. And I guess most troubling is a dynamic that has taken hold in the market. The banks stock prices are declining, and that's weighing on the confidence of depositors. Depositors have no incentive to keep their money at banks when they're worried about them. And, as Bill had talked about, the speed and the technology that enables depositors to pull their money and move them out of these banks is quite quick. So all of this is sort of exacerbated and expedited by social media. So, but even before SVB's failure, I think it's important to note that bank stocks were not popular with investors anyway. There were the backup in rates, market volatility that was being caused by many reasons, and then the increasing odds of a recession were creating headwinds for bank earnings in an environment where investors just really didn't want to be in bank stocks. Following SVB, investors quickly focused on a few things. First, they started looking at the deposit composition of in banks. Most importantly, they were looking at the percentage of uninsured depositors at the various banks. Then they were looking at their capital on a mark-to-market common equity tier 1 basis. So investors were very focused on capital ratios, adjusting them for unrealized losses and available for sale books. They were focused on earnings, asset sensitivity, and deposit costs. And then they were also concerned about their credit. Again, with the increasing probability of a recession, investors are becoming more and more focused on that, particularly looking at concentration of commercial real estate exposure and in drilling down even deeper in commercial real estate, looking at office exposure. As I mentioned earlier at the beginning, investors are opportunistically looking for the next bank to fail. They're shorting a wide range of bank stocks. And I'm not going to mention names of these banks, but we've seen significant sell-offs in certain banks. Despite the fact that many of those banks had reported in Q1 deposit outflows were fairly limited or had stabilized. So markets are now looking for policymakers to relieve this uncertainty and concerns around the banking sector. There are two ways that are, circulating among investors that they believe will help stabilize the current situation. I'm not really advocating for either of these ways, but I will, share when you talk to traders, investors, they all say there must be a blanket guarantee of deposits that will effectively de-link equity prices from deposit behavior. I appreciate the moral hazard around this. I'm not sure market participants have as much of an appreciation, but there's a very popular view across the market that this has to happen. The other one is the Fed needing to cut rates, shifting away the probability and liquidity pressure. Shifting away the profitability issues and liquidity pressures that are on the banks. Investors see these two possible policy responses as a way to instill confidence in the system. During the financial crisis, I think it's important to note, at least in my view, I'd be interested to hear what Bill Dudley has to say, but I felt the inflection point came when the Fed assessed how big the hole was in the bank balance sheets through stress testing, and then had the capital to inject into the system with TARP dollars. That allowed for the banks to repair their balance sheets and earn their way to a better state, and also to adhere to stricter regulatory standards that were then implemented. Regional banks are not able to raise capital in this environment. I agree with Bill on all the points that he raised and the report with the new, tightened regulatory and supervisory proposals that have been put out on the table. But it's going to be really tough for these regional banks to meet them. There's very low likelihood of external capital raised at these distressed valuations merely to solve for AOCI. And we've seen numerous examples of regional banks going to the market to raise capital, but failing. In the C-suites of some of these smaller regional banks, management is talking about how to instill confidence in their deposit base. A number of senior management teams have indicated that deposits remain robust, and many of them have letters that they've issued or letters that they're ready to release, with that message that that their deposits are robust. But it seems to be backfiring. It's taken by investors as an act of desperation. And we've seen that banks that have released those letters saw their stock prices decline even further. So the backdrop is quite challenging for banks. And as Bill mentioned, they're used to operating in a zero interest rate environment, and the current market ecosystem is one that has been built in a zero interest rate environment with lots of liquidity. Now we have fears of recession setting in, concerns around commercial real estate and other credit concerns, which have been growing for some time, but just accelerating right now. So for some time, banks were already starting to tighten credit due to these odds of an economic slowdown and a recession. And also, as the Fed shrinks its balance sheet, deposits are leaving the banking system. So from a cyclical standpoint, there has been little appetite for investors to own banks even before the failure of SVB. But, that appetite is, diminished quite a bit since then. So banks are now looking ahead, and investors are watching banks in light of this coming enhanced regulation and capital requirements. And even if the regulators give banks 3 years to raise capital and meet these new standards, the market's not going to give them this time. They're going to look to see who can get this done today. So any proposal that's on the table, whether increased supervision, stress testing, enhanced regulatory capital requirements, are also going to be bad for ROE, making it extra challenging for banks to raise equity. The Bank Term Funding Facility, the BTFP, was very helpful. It was a helpful band-aid for certain banks, such as First Republic, but it's not a long-term solution. Banks were paying 2% for their deposits, and they're now paying through the BTFP 5% to access the facility. So again, it's harmful to their ability to generate profitability. Our estimates suggest that some banks will need upwards of 30 to 60% of their existing market cap to meet this potential new capital requirements, which will likely, which will require banks to incorporate gains and losses associated with their available for sale securities portfolio into capital. Again, for all the reasons discussed, it's going to be very hard for banks to earn their way into these new capital requirements. Almost all of the banks have already turned off their share repurchases, and many have been public about reducing risk-weighted assets. In fact, we've seen increased activity on our loan trading desk from regional banks selling portfolios of loans. And despite the low valuations, M&A activity remains extremely challenging when purchasing a bank. The acquirer needs to mark the entire asset base to market, which reduces equity and creates a capital need for the acquirer. The FDIC, when placing a bank into resolution, has the ability to allow those losses to be borne by others, including preferred and debt holders, and most importantly, can recapitalize the bank using funds from the DIF, the Deposit Insurance Fund. The DIF has about, it seems to have roughly 33 billion of losses to date. So rather than doing M&A, it's better for potential acquirers to wait for an FDIC takeover and then buy portions of the bank from the FDIC. To summarize, uncertainty remains in the markets, and there are very few catalysts, absent policy action, which remains now to instill confidence in the sector over the near term. And with that, I'll turn it over to Bill Rhodes.
Well, thank you very much, Hayley. I think you gave a very detailed, kind of somewhat scary picture of where the banking market is. And Bill, you covered the Barr report. I just have a couple of observations being the old guy here who's seen a lot come and go in various crises. And Bill touched on this point, which I think we can't underestimate, that the Fed delayed 6 to 8 months in raising interest rates. And it was very apparent during that period that inflation was rising rapidly. It wasn't just the Fed. The European Central Bank did similarly, I think, made similar mistakes, but it was more, I think, apparent in the case of the Fed. And then, of course, anytime I found when you try and play catch-up ball, raising interest rates very rapidly at very high rates, it's very difficult for commercial banks to adjust their portfolios rapidly enough. And at that point in time, the supervisors, whether it be the Fed, the FDIC, the state regulators, basically should have seen this and stepped in earlier. It goes to the old maxim of borrowing short and lending long. And I think this was one of the points that we saw, because the regional banks were very heavily invested in long-term treasuries, real estate, which Hayley commented on, and other such assets, even in the case of Silicon Valley Bank, crypto. I think one can't underestimate the impact of the role of Dodd-Frank legislation being modified in 2018, notwithstanding that one of the authors of this, Barney Frank, was on the board of Signature Bank and lobbied very hard to modify it, which is, mind-boggling to me, but that's what occurred. So making banks with less than 250 billion, requiring less capital, stress testing. Obviously, the idea here was that they did not pose a systemic risk. Well, we've seen what can happen in this new age that we're living in of, rapid, I think, social media, which we really didn't have to this point in the last great financial crisis in 2008. Obviously, Bill has commented on the failure of supervision, of the Fed, but it was all of the regulators. So you can't put the blame just on the Fed, because there were these other regulators that were supposed to be checking up on these banks also. So I think that can't be underestimated. One of the things that I think has gotten lost here in everything is the role of risk management. Having been a risk management and have to clean up a bunch of messes over the years at an institution I was affiliated with for many years, the importance of good risk management is I think, basic to the running of a commercial bank. In fact, to any institution, but particularly a commercial bank. And it is notable in Silicon Valley Bank, you did not have a risk manager for almost 9 months. How the board, and a board is here, was obviously not doing its job, or the management, in allowing the institution not to have a senior risk manager. I've always pushed the idea that the senior risk management in a financial institution ought to go directly into the board, have access to the board of any financial institution, particularly a commercial bank. Then, as I was mentioning, as before we got on the formal program, having shared offices with Paul Volcker the last years of his life, Paul used to always kid me and say, the problem with the bad regulator and a bad supervisor is they get too close to the institution they're supposed to be supervising and regulating. And you always have to remember, he said he always told his supervisory team when he ran the Fed, both in the New York Fed and the Federal Reserve, that the supervisor is not supposed to be the banker's friend. I think that what we're facing now is whether the Fed is going to pause in raising interest rates. And one of the dangers, if it's not clear that inflation is under control, is what Paul faced when he took over the job under Jimmy Carter, with Arthur Burns having gone back and forward on interest rates. And I think that if you get a pause now in interest rates, that would help, I think, this whole banking crisis. Unfortunately, it could put us into an area of stagflation here if this is not pursued to its final point. Anyway, I really believe we're on the edge of either recession, which Hayley commented on, or stagflation. Lastly, just a couple of points. I think if the answer to bailing out the regional banks, and Hayley didn't mention them, but she made the point there are a number of them under stress, is that if the major banks, the too big to fail banks, are the ones that have to bail them out all the time, that just increases the problem that we came out of the 2008 financial crisis of too big to fail. So we have to be very careful here, because the country needs strong regional banks, without a doubt. And, we don't want to end up like Canada or some of the countries in Europe where you only have a few banks, because I don't think that really is what we want here in the United States. It was commented on before about the role of social media. I just mentioned it. I think that certainly in the Silicon Valley Bank, Signature Bank, also I think in Republic, it played a real role, because things multiply so rapidly today that they didn't in the past. Then there's always the problem of contagion. And contagion obviously is at work here with what's going on with some of the regional banks that have been under pressure recently. The other thing is that it can also go internationally, as we saw in the great financial crisis in 2008. Already we've had, and Bill knows this well because he's on the board of the bank that ended up as the only single major bank in Switzerland, Union Bank of Switzerland, is if there's a major bank that's under pressure, in this case, Credit Suisse, or even there was a run for a short time on Deutsche Bank, this local phenomenon we have in the United States can become an international one. And so I think all of these things have to be taken into account here. So the sooner the changes that needed to be made are made, the better off we would be. But I don't think the supervisors or the regulators can wait for Congress, which is so split today, to do anything about revising back to what we were in the original Dodd-Frank. They have to take action on their own. And where the Barr report, I think, was very self-critical, I think you need a timeline here as to when this is going to be corrected. And not just by, as I said, the Fed, but also by the local supervisors and in this case, the state regulators, but also the FDIC. So with that, I think, Elena, I leave it because we want time. You wanted half an hour for questions, and that's what we have left.
Before we start with opening up the audience, I have a question for both. I have one for Hayley, and then I have one for Bill, if that's okay. So Hayley, you basically created a pretty pessimistic view that we've sort of transitioned now from the deposit flight stage, where people are able to fund themselves because they have access to the discount window of the Federal Home Loan Banks. So the deposit flight is mostly stopped. But we're now in the sort of what I would call the earnings phase of the crisis. And you're, I think, pretty pessimistic about how long that's going to take to work out. What brings relief to the regional banks? The ultimate reduction in short-term interest rates, a year or two from now? Or do you think this is going to take even longer than that to work out?
I think a reduction in interest rates would help. I'm concerned that we actually haven't left the deposit fight stage. I'm concerned that as there's more talk around, and again, I think it's needed, but more talk about enhanced supervision and regulation, and the market looking at these banks and saying, hey, they're not going to be able to meet it, or looking or bifurcating, saying, okay, this group can, this group can't. Stock prices go down, depositors lose confidence, and again, lead those banks and just making the problem worse for those banks. So I'm a bit worried that we haven't left that stage, but they do have an earnings problem. So I think, there are a lot of things that we can't control around volatility, that's driving some of the volatility in the market. There's a lot of geopolitical issues that are causing volatility in the market. I think, I also feel like, yes, reversing course on interest rates would be helpful, but I also just think clarity around the path of interest rates would be helpful. If people could understand what the environment's going, there's just so much uncertainty right now. And if investors or even banks understand what the path might look like going forward, then they can manage to it. But uncertainty, it's just, it makes it very, very difficult for the banks to manage through, and also the investors. I'm not sure that's something anyone can deliver. Obviously, the Fed has to behave in a data-dependent way, but this lack of clarity and all this uncertainty is making it the environment extremely challenging.
I mean, I agree. I think the Fed's monetary policy is much more difficult now because they don't know how bad the banking system is going to be, how long it's going to last, and how much credit restraint is going to occur, and how that's going to affect the economy. So the way I sort of describe it is, before you were driving in the sunny, you sort of knew where you were headed and you could see pretty far down the road. Now you're driving in the driving rain. You just don't know what's going to happen to the banking situation. So it makes it much more difficult to figure out what's the appropriate trajectory of monetary policy. Let me turn to Bill Rhodes for a second. One aspect of the Fed report that I thought was interesting was the fact that Barr did touch on the issue of compensation. So I'd like to ask your views on that, whether bank compensation should be changed in some fundamental way. And the second thing I want to ask you about is, we have an interesting regime in the United States where firms are supposed to disclose material things that affect their livelihood, but they're not allowed to disclose, bad supervisory findings. Is the fact that we keep the supervisory findings secret, is that a good thing or a bad thing? In other words, if you disclosed it with a 6-month lag, would that create more incentive for banks to get on with things and fix things sooner? So compensation, disclosure of bad supervisory findings, those are my questions for you.
Yeah, you saved the tough ones for me. By the way, I agree with you. I agree with you, Hayley. But if we had Powell here, he would say that he's not really sure what's going to happen. So I think that's the incognito, as we say in Spanish here. But I think bank compensation has got out of hand. I really do. And I think particularly on the more senior levels. And I think this is really a problem when you take a look at the seniors as, in respect to the bank employees themselves. And, I would have plenty of arguments today about, from bank boards, but I do think compensation, is a real issue, considering where compensation has gone over the last, not 10 years, but really over the last 15 to 20 years. I think as far as making, what is said in these reports about banks available, which is what I think you were saying, what the regulators' supervisory reports say.
With a lag, not right away.
Yeah, with a lag. Yeah, with a lag, I think is really a difficult question. My feeling is the sooner the better, frankly.
I think if you
even though it could cause disturbances, because I sometimes think the banks are in these descent degrees, and people don't understand what that means. And I think it's very important that they do. So I'm all for strengthening the supervisory and regulatory role as much as possible and have as much clarity as possible. And I know a lot of fellow bankers, although I haven't been in the banking business a long time, would disagree with that. But that's where I come from in that particular area. And so I really think, and I tend to go along with Hayley in this, I think we're in for some tougher times here going forward. I don't think that this is just something that's going to end very quickly. I think we're going to have to see a fallout. I'm not saying that we're in another 2008, financial crisis to that extent, but I do think, that we're going to see fallout here, and we're going to see more contagion. And the sooner the supervisors and regulators move in this issue, and that we get proper risk management in some of these institutions. And I really think the supervisors have been very lax in insisting on strong risk management, particularly the role of the risk manager in an institution. I mean, we came out, as you know, Bill, with these reports from the group of 34 of them. And one of the key points here was the role of the risk manager. And unfortunately, this is something which a lot of institutions don't put very much importance on. And so I would just emphasize this going forward. And it should be disclosed, I think, that the risk manager has access to the board. In some cases, probably should be a member of the board, but if not a member of the board, at least access to the board on a regular basis.
Thank you for that. Yeah, I think that's very, very, very sensible. Elena, why don't we open up now for?
Neil, I think that Hayley wants to speak.
Okay.
Yeah, Haley's got a
I
point.
just want to add two things.
Sure.
You're asking me what you thought could help earnings. Tried to address that list. But I have one concern about what is going to be, what's coming up really on our doorstep now, and very concerned about the implications, which is a looming debt ceiling issues. That's going to create a lot of more volatility and uncertainty in the market. And given the fragility of the market, I'm quite concerned about what the impact is going to be there as that plays out. But Bill Rhodes, just to some of your comments, and Bill Dudley around transparency and supervision, I think it's important also to mention the increasing role of non-banks in credit extension, and acknowledge, the really limited supervision and zero transparency that we have from that sector, which is growing quite rapidly.
Yeah, one of the problems here is if you increase the regulation on the banks, you just squeeze a lot of that activity into the non-banking sector.
That's
so
why.
Are you actually in a better place, or are you actually in a worse place? And I think the challenge that you've
on that, I would just say that this was one of the things, and I'm glad you brought it up, Haley, that was supposedly going to be worked on after the great financial crisis in 2008, because this has already come up about regulation or lack thereof of the non-banking sector. And really nothing's been done in that regard. And I think that's a real problem also. Then, Bill, I would ask you I have one final question before we open it up for you. What do you think the role is of the U.S. Treasury in all of this? And I thought about this when Haley mentioned the point about the debt ceiling. Where do you see the role of the Treasury in coordinating everyone together? Because you work very closely with Janet Yellen in various capacities. And I'm just wondering, because I get this question all the time, what has the role of the Treasury been in all of this as sort of the senior coordinator of all of this, the supervisory institutions?
So I think the Treasury role is really in sort of two different ways. Number one, the Treasury can be a source of equity capital to backstop Fed facilities without requiring congressional legislation. And they take that from the Exchange Stabilization Fund. So that's why the bank term lending facility could be set up so quickly. And number two, the Treasury plays an important role because the head of the Treasury is the chair of the Financial Stability Oversight Council. Now, I think it's fair to say that the Financial Stability Oversight Council hasn't been as effective as one would have hoped after its establishment in Dodd-Frank. But in principle, the Treasury Secretary does have that as a mechanism to bring together all the various players and try to achieve a coordinated response. One of the problems we've always had in the United States from a regulatory perspective is that the banking regulators do really worry a lot about safety and soundness, but the Securities Exchange Commission and the CFTC are not so focused on those things. And as you said, as Haley said, a lot of the activity happens in the non-bank sector. And so the focus on safety and soundness in the non-bank sector doesn't probably get the degree of scrutiny that it deserves. Elena, should we open it up for questions?
Absolutely, Bill. Thank you all for sharing your thoughts and insights on this issue. I am going to invite Mahesh Koteka to ask the first question. Mahesh, are you there? Mahesh, can you hear us?
Yes, yeah.
Oops. Let's see. Mahesh, can you unmute?
Yes, can you hear me?
Fantastic.
hear me
Now we
now?
hear you.
Great, thank you very much. Really an excellent and a very timely presentation. And Bill, Dudley, thank you for the comments you had, very candid comments also on Bloomberg just shortly after the chairman's Powell spoke. Very refreshing to hear candor and to tell it like it is. Two questions. One, on interest rate risk issue that you pointed out has not been addressed in the Fed report. Isn't that really a standard test that one should do? It's really standard part of risk management, and certainly an oversight on that. It's a lacuna when interest rates are rising so rapidly. So why not comment about it? What is the message in not commenting on that? And second, with respect to Hayley's discussion on and Bill Rhodes underlining the importance of the regional banks and difficulty of getting capital, which will be needed. Would you foresee pressures for consolidation, further consolidation? There used to be, when I started out, 17,000 banks. Now we got 4,000 U.S. banks. Are we going to end up with much less? Thank you.
Why don't we start with that second question for Hayley? I mean, one interesting issue about the banking situation is the big money center banks have a 10% deposit cap that they can only be waived if they're acquiring a failing bank, and which was waived when JP Morgan bought First Republic. So, if there's going to be consolidation, it sort of has to be among, I think, more of the regional banks themselves. But I'd be curious what Hayley's response to that question is.
No, I agree. I was going to give a pretty short answer, and it was going to be yes. Yes, I think there will be, and there'll have to be. But again, for the reasons I noted earlier, unfortunately, strategically, it's almost better to let them fail, FDIC take them over, and then buy from the FDIC. And Bill's right, these approval process is quite slow and long. So unless there are exceptions made, I don't see a lot of activity happening from the very large banks, but it'll probably happen. It will happen across some of the non-GSIB banks.
Yeah, I would just, to the point about, are we going to have fewer banks? Without a doubt. I think we're in a period of consolidation here. And I think it's going to happen one way or the other. The question is, does it happen in an orderly fashion, or is it going to happen in a disorderly fashion? And going back to the point that Hayley made at the beginning in her, in her presentation, I think we are on the edge of a recession, or at least stagflation, which I think will give further impulse to consolidation here. And so I think consolidation is going to be the name of the game going forward.
So Mahesh asked about the interest rate risk issue, why it wasn't addressed. I mean, I think the Fed is very much aware of the importance of good asset liability management. So I'm not really sure why they didn't comment on that more directly in their report. I certainly think it's going to be a focus more of the supervisory process to focus on interest rate risk issues, because the mismatch here is what really generated the problems at Silicon Valley Bank and at First Republic. They had long-term fixed rate assets that they were funding with short-term runnable liabilities, and that's asset liability management. So I think it definitely will get more attention from the Fed.
Bill, one of the things that I didn't see in the report is what is the timeline for correcting some of these things? I think that is when you listen to Hayley's presentation on everything on the table, you read the Barr report, and then you question, what is the timeline to do something here? Because it's not like we're going to have an immediate modification of Dodd-Frank back to what it was before 2018. So this has to be done by the supervisors themselves.
Yeah, I think the supervisory response will happen quite quickly, but you're absolutely right. The response in terms of changing the degree of tailoring for these medium-sized institutions is going to take quite a bit of time, because the Fed is basically going to go out. It's going to have a new regulation. They're going to have to go out for comment with that regulation. They're going to have to get the comments, and then they're going to have to finally develop a finalized rule. So the new regime for regional banks is probably going to take a year and a half, 2 years to fully arrive. This is not something the Fed is going to do very quickly.
Just one thing on interest rate risk. On the interest rate risk, that's somewhat of a complicated issue, because in a higher rate environment, banks actually, improve their NIM. So it can be a very positive thing for the bank. I think Silicon Valley Bank was unique because they sold their lower yielding treasuries, bought higher yielding treasuries to improve their earnings before they locked in capital. So they took a big hit on that trade. But it's difficult, challenging for the Fed to incorporate that to model that for banks, because again, it actually should be a positive thing.
Yeah, your point is very well taken. What's the duration of a demand deposit from a corporate business, from a business customer that's really tied into the bank? That duration of that demand deposit is probably very long term. And that's why asset liability management is actually pretty difficult, because if the deposits can run, the maturity is really short. But if the deposits are sticky, the fact that you have a lot of business deposits can be actually a very valuable thing.
And that's what gets back to this whole question of good risk management. Because if you don't have good risk management, then you can't weigh the importance of these points.
So I am here trying to find a question that you haven't answered yet, because your look is very comprehensive. I am going to go to Gregory Johnson. Gregory, do you want to speak up, please?
I'm happy to. Thanks, Elena, and good morning, everybody. Thank you for the insights. Just a comment first before the question, just the notion that we don't even have, a hotline to ERM to the board level is just absolutely just a stunning revelation. So the conversation around enterprise risk, I think, is enlightening, to say the least. I can also tell you that the themes that you're sharing are so sober and largely absent from all of the Milken talks this week in sunny Beverly Hills. So I'll tell you that. Hayley, I have to say, your question, you mentioned shoes dropping earlier in commercial real estate, and I couldn't help but think, we had our crisis du jour last year in China's real estate bubble with Evergrande, and then it kind of magically disappeared, and we rubbed some money on it, and then all of a sudden it's gone. Do you view that as maybe one of those kind of next shoes to drop? And I'd open up to either of the bills as well, but I thought I would leave that with Hayley first.
Commercial real estate?
Yeah, in China, I just wonder, there was so much talk about that we had that moment last year, it went away, but I wonder if that could be one of those other shoes we haven't been talking about as much.
I'm sorry, speaking specifically about real estate in China or real estate more generally?
I think
commercial real estate in China being a catalyst for.
There's a lot of chatter about it, right? There's a lot of chatter about it. When we look at it, we're not quite as concerned. And I remember, Bill, during the financial crisis, we were quite concerned about bank exposures to commercial real estate. The banks aren't really incentivized to foreclose on those loans. So they have a great ability to, I think the term we used then was pretend and extend, or mend and extend, or maybe we said pretend too, but you could amend and extend. So we're not all that, the market is very focused and very concerned, and the exposure for some of the regional banks is highly concentrated and should be concerned and should be, is of greater concern than, certainly for the G-SIBs. And I love your comment, Gregory, around the Milken conference. I was there as well, and I was kind of surprised how little discussion there was on this, but the AI seemed to be dominating every single discussion that I went to.
Right.
But Bill,
I would just add here that I think on the regional banks, I think a number of them are very highly concentrated in real estate, and this is going to be a problem for some of those institutions. I think for the larger institutions, the too big to fail institutions, I agree with Hayley. I don't think this is going to be a big problem. But I think some of the regional banks are really deep into this, and which could cause, further contagion and problems down the line.
Terrific. Thank you all.
Thank you, Greg. I am going to go to Herman Mulder. Herman, can you turn on your microphone, please?
Yes, I have. Thank you very much, Elena. Thank you very much, Bill, and Hayley. I'm calling from Amsterdam. I have two questions. I'm happy that Hayley was addressing the gorilla on the basketball court. We have specific attention to the banking sector, but a lot is happening or not happening in the non-banking financial sector. And my question is, first, how big is the systemic risk which the non-bank financial sector is posing now? And second, my second question is, are we seeing now an acceleration of a structural disintermediation of the regulated banking sector? And what should be the regulatory response to that? Thank you.
Yeah, you want to take first crack at it, and then I'll add a few thoughts.
Well, I think that.
Why don't you go ahead, Bill?
All right, why don't you go and start?
I was just saying, I did a lot of work. Yeah, as you know, I'm on banks and did quite a bit of analysis around 2010, 2011, published a paper on non-banks with some others from the Fed. But I don't know what the size is today, but and I'm not sure that there has. It actually, a couple of weeks ago, I was thinking that it would be great to do that, to try to dimension this, at least how much credit creation is coming from the non-bank sector. But I will tell you the transactions that I'm seeing are somewhat astonishing. You have non-banks financing other non-banks to do origination deals. Now that's something that's new in the last year or two. So there's just a lot of activity that's moving off of bank balance sheets into the shadow banking sector. But I don't know, Bill, if you've been aware of any recent work that's been done to try to figure out what the size is. I would say from an asset liability perspective, their funding they're not deposit based. Many of them are funded by pension and insurance funds, which tend to be longer in duration. So they may be more well matched, duration matched.
I think that, just to add to what you're saying, Hayley, we also have something that we didn't have in 2008, which is the crypto world. And I think this has exacerbated this whole question of shadow banking, because there are so many institutions now that are deeply involved in that. And they're really, in a sense, shadow banks in the crypto world. So I think, Herman, you asked a very important question. So I think we've mentioned it several times here. It's something that needs to be looked at very seriously, because here you have the banking system, which all of its flaws, is regulated normally pretty well. And of course, we have all the exceptions we're discussing here. The non-banking system is really not regulated at all. And that's one of that's really one of the problems. And it's, as I said, it's been exacerbated by all of what's occurred over the last couple of years in the crypto world, where some of these crypto companies claim they're, pseudo banks. And even Silicon Valley Bank was highly leveraged by involving itself in cryptocurrencies.
I just have 2 points, one a positive and one a negative. The positive is that, as I think Hayley mentioned, a lot of the funding of these non-banks is institutional funding, longer term funding. And a lot of the non-bank sector has the ability to put up gates. So if people want their money back, the institution can say, no, you don't get your money back for a number of years. We saw that in the case of Blackstone recently with their real estate investment fund, which means that you don't have this situation like, where basically people can get their money out, which forces the institution to sell their assets, which depresses the asset prices, which causes people to pull their money out, that vicious circle that we saw during the great financial crisis. So that's sort of the good news. The bad news is just the lack of transparency. You don't know what you don't know. We just can't see what's really the vulnerabilities within the shadow banking system because we just don't have that transparency there. And so as long as nothing's going wrong, we can sort of say, well, everything's fine in the non-bank sector, but we can't be confident that if stress in the financial sector broadly goes up, that things aren't going to start to break in the non-bank sector as well.
Yeah, and I think that going back to a point I made earlier, there really hasn't been much progress since the 2008 financial crisis in this area. And I think that's a real vulnerability going forward. I don't know, Herman, what you think you see in Europe, because we've been talking basically about the United States. We, brought up China here, and I would just make a point on China that they have their own problems with their regional banks, which is one of the downsides that really has been exacerbated by what's going on here. And so, this is sort of, when you talk about contagion and worldwide phenomena, these things aren't just isolated to the United States, but I'd be interested, since, you coming from Amsterdam and are a former banker, what you think about it.
Well, thank you very much for the question, Bill. As you know, we all know the banking sector in Europe is much more dominant than it is in the US, which means that potentially the problem is even bigger if the supervisors or the regulators are not going to step up to prevent the leakage out of the regulated banking sector. And I think what's going to happen in Europe is now the acceleration of creating both the banking markets union and the capital markets union, because that is where we have an incomplete regulatory environment. We haven't seen many, and the ECB is also looking at increasingly at liquidity positions of the ALM position of the bank. So there is definitely a warning signal here, both with the banks and the regulators. But we are, in terms of regulations, we are still behind the US on the one side. On the other side, we do have the benefit that more of the financial markets in Europe is in the bank market. So it is still timely enough to take the appropriate measures that we do not have a very vulnerable non-bank financial sector. And we all know what happened in 1998 in Thailand. It was the MBFI which triggered the problem. So I think the point of transparency is extremely important. And I think definitely that I would assume that the ECB is focusing on the transparency of whatever the non-bank financial sector in Europe is posing as a potential systemic risk.
Thank you, Herman. If you don't mind, I'm going to go ahead with one more question. I don't think we will be able to go through all the questions. I'm going to give the floor to Jorge Bermudez. Jorge, are you there?
Yes, can you hear me?
Yes.
By the way, thank you very much for your comments and bringing some clarity to the situation that we're going through and the emphasis on risk management and the asset liability committee process. My question has to do with what, if anything, can be done with what is happening with short sellers and hedge funds, which are exacerbating the crisis environment that we're going through at this point.
There's a pretty big reluctance in the United States to put bans on trading and short selling, because when you do that, you're actually sort of suggesting that things are actually even worse. So it's not clear that implementing a ban would actually be helpful. I mean, you get a near-term rally as people were forced to cover their short sales, but it's not clear that that would really be, reassuring. Obviously you can imagine if things got bad enough, there could be a ban on short selling, but I think the bar to doing that is pretty high. Hayley and Bill, what do you think?
I agree. And if you recall that there was a short sale ban that was put in place during the financial crisis in 2008. And there have been a lot of studies done on that and the effect of that. And they show that the effects of that restriction actually exacerbated, as Bill points out, some of the market downturns. It failed to slow the decline in the price of many of the stocks at the time, and prices fell quite a bit over the 2 weeks, which the ban was in effect, and stabilized after it was lifted. So there's no, again, as I said, there's some short selling happening today out of fear that there's a rumor that there are going to be short sell bans put into place over the weekend. But as a former policy person, I don't it's not a practice that I would advocate. And studies have shown that it wasn't really helpful in stemming the decline in asset prices.
Jorge, as a former senior director of the Dallas Fed and also a senior risk management, what is your thought on your own question? In other words, what do you think the seriousness of it, and do you have any specific solutions to that?
Thank you for putting it back to me, Bill. No, I agree. There's no doubt that putting bans on short selling may not necessarily be the right solution, but if the crisis gets to a certain point, I think it's got to be one of the options that is looked at, because so much of the uncertainty is being exacerbated by these actions. And my question really was wondering if this was an option that policymakers would actually look at again.
I think we're gonna have to wrap this up since we're at the end of our available time. Elena, you want to close us out?
Yes, absolutely. I wish to thank everyone for, giving us and enlightening us on the topic. I look forward to the next conversation. And again, thank to all of our speakers and to our attendees for being with us today. Thank you.
Thank you.
Thank you.